Yeah, welcome back everybody. This is another exercise case to VAT and well, let's not waste time for an introduction. Let's just begin. And so let's have a look. John Selling is a car trader in Stuttgart, Germany, and on the 1st of February 01 he sells a new car to one of his customers, a certain Bernd Bayer from Berlin. The price has to be paid in installments. The first payment is due in February, amounting to 5,000. Then 40 months are planned at 500 each month. And well, in June 02, however, Bernd Bayer dies in a car accident inside that new car. There are rumors that probably technical mistakes in the car are responsible or something like that, and it seems impossible to recover the future installments from Bernd's heirs, so all the future installment payments from July 02 onwards are lost and cannot be collected. What's the correct VAT consequences? Well, the first step is probably again to illustrate what happens. So who has a contract with whom? This is John Selling in Stuttgart, Germany. And the other person involved is Bernd Bayer from Berlin. And what happens is that a car is sold. And what is paid is, or the price is 5,000 plus 40 times 500. And now we have to think about what happens. However, we can also think about the places where the good is moved from. Stuttgart is where the good is at the beginning. And at the end it seems to be in Berlin. Okay, so that's what happens here. And now we have to think about the correct VAT assessment of that case. So taxability to test is again paragraph 1, number 1, because the only viable alternative, which would be number 5, is something which we have not yet discussed and which is not possible here. Let's just believe that. Do we have an entrepreneur as the person who acts? Yes, John Selling is a car trader, so an entrepreneur. Sentence 1 and 3 of the USTG. Acts within his enterprise as paragraph 2, 1, sentence 2, USTG. That selling cars by car trader is evidently a part of his enterprise, even the main objective. It would also count if it were just an occasional opportunity combined with enterprise activities, but it's even the main one. Yes, he demands a price. Do we have a delivery of a good? And the answer is yes, because a car is a tangible good and selling it is transferring the position like an owner. Now, is it in the inland? For this we need the place of delivery. That is to be determined either by 3.6 or 3.7, depending on whether the good is moved during the transaction or not. And it is moved, so it's 3.6 sentence 1, where the movement of the good towards the customer begins, so in Stuttgart. So that is a taxable transaction in Germany. We have now, as the next point, the question if there is a tax exemption. Paragraph 4 says no, so it's liable to tax. The tax base is paragraph 10, one sentence, 1 and 2. Everything which Zelling receives for the delivery. And now the important thing is, everything which he receives is not everything which he receives at the moment. There is no restriction in time, so everything which Zelling receives from here to the end of eternity. So that's 5,000 now plus 40 times 500, so 25,000 in total. This is the gross payment, because the formula does have no focus on a point of time. So everything, whenever it has to be paid, is included in the tax base, minus the VAT included therein, 19 out of 119. So the net amount is 119 times 25,000. So that should be, let me have a look. Calculator is a perfect invention. 21,008.40 euro. The tax rate and tax amount is 19% on 21,008.40. That's 3,991.60 euro. Paragraph 12.1, and the reason is because 12.2 does not apply to cars. So no reduced rates for cars. However, in June 2002, things change. Now it becomes clear that John never gets more than 5,000 plus, well, March, April, June of the first year, plus 12 additional months, 15 times 500. So 12,500. So in June 2002, correction of the tax base has to be declared. 119 of 25,000 minus 12,500. So 12,500 divided by 1.19. 10,504.20 is the actual tax base from the retrospective, and the tax base goes down by, that's by chance now, same amount, 10,504.20 euro. So it reduces itself to 50%. The 50% is here just a coincidence. That was not deeply planned. If the percentage could be different in other cases. In June 2002, the tax goes down to 19% on 10,504.20. So 1959.80. Formal aspects. Payer is John Zelling, because he is the entrepreneur. 13A on number 1 USDG. Then arisal of the tax. That's now bad. The tax arises completely when the delivery is made. not when the money comes. So the complete tax of initially, what was it? The initial tax was 39960, becomes due at the end of the preliminary declaration period, February 01. See paragraph 13, 1, letter A. When the situation changes, a refund of the difference here, 99.80, is declared claimed in June 02, see paragraph 17.1 USDG. Now let's think about invoicing details. Originally, John has to issue an invoice confirming the complete price and the complete VAT contained in the price in February 01. It does not matter if the amount has already been paid. Later, when the remaining amount is lost, it might be necessary to correct the original document in order to make sure that not an invoice is still outside, which confirms more VAT than what is due. However, in cases of bankruptcy, insolvency, or similar events, the German fiscal administration does not insist in that. So probably not a big problem here. Declaration duties, nothing special. Peculiarities which are completely outside our usual testing scheme and had to be commented here. There are none. And input tax refund claims. And buyer can claim input tax if he uses the car for his own enterprise. In such a case, the input tax would have to be corrected at the moment when the VAT goes down, June 02, because because it is clear that no VAT must be claimed, refunded, which is higher than the VAT which is owed under the law by the seller. Naturally, John selling can claim the input tax which was contained in the price when he bought the car from the factory, 15.1, number 1. When his own sale price goes down, there is no correction of the input tax for the acquisition of the car, because input tax claims are only denied if you sell tax-free, and he does not do this. Losing a claim is not selling tax-free. That's something completely different. So these were my small remarks on that case. So I hope it was interesting. If not, and I hope that the next case might be interesting. And in all the world circumstances, I would wish you a good rest of the day and see you back soon.